Welcome in everyone to this deep dive into the world of personal finance. We're cracking open Beth Kobliner's Get a Financial Life, a roadmap designed to help you take charge of your money, especially if you're in your 20s or 30s.
Yeah, navigating the world of money can feel overwhelming, right?
Absolutely, especially with the economy throwing curveballs these days.
It can feel like you're constantly playing catch up. But here's the thing. Taking control of your finances, even without a massive income, is completely achievable.
That's reassuring to hear. So where do we begin?
Well, let's start with the basics. Health insurance.
Okay, health insurance. Something many in their 20s and 30s might overlook.
Exactly. You might think, I'm young and healthy, I can skip it for now. But trust me, an unexpected medical bill can seriously derail your financial progress.
So true. How do we navigate this, especially if our employer doesn't offer coverage?
First, check if you can stay on your parents' plan. Most states allow this until you turn 26. New Jersey even stretches that to 30.
That's good to know. What if staying on a parent's plan isn't feasible?
Well, you can explore joining organizations that offer group rates. They often have better deals. And if you're between jobs, look into temporary health insurance plans just to bridge the gap.
Right, those temporary plans can be a lifesaver. Okay, what about online resources for finding individual policies?
Websites like eHealth Insurance or NetQuote, they're excellent for comparing different plans and finding one that fits your needs and budget.
Perfect. Now let's talk about something that can be a major source of stress debt.
Ah, yes, the dreaded D word.
It looms over so many people, especially those high-interest credit cards.
Those can be a real financial drain. Interest charges pile up and it can feel impossible to get ahead.
Exactly. What's the best approach to break free from that cycle?
You'd be surprised how often credit card companies are willing to work with you. So, step one, call them, negotiate a lower interest rate. Be polite but firm.
So directly reaching out is key.
Mhm.
Got it. Any other strategies?
Definitely check out websites like credit.com or cardtrick.com, even lowcards.com. They let you compare different cards and find ones with lower rates, maybe even perks that suit your spending habits.
Oh, that's helpful. Now, what if we have multiple debts, like credit card debt, car loans, student loans? How do we prioritize repayment?
Always tackle the debt with the highest interest rate first. It's the most efficient way to minimize the total interest you pay.
Makes sense. Stop the bleeding from the biggest wound first. So in that scenario, paying down a high-interest credit card, even if it means stretching out a lower-interest student loan, might be the better move.
Precisely. You'll save more money in the long run by focusing on that high-interest debt.
Okay, let's delve deeper into student loans. They're a common burden for many, especially those just starting out.
Oh, for sure. There are two main types, federal loans and private loans.
What are the key differences?
Federal loans typically have fixed interest rates and offer more flexible repayment options.
And private loans.
They can be a bit trickier. They often come with variable interest rates, which can make budgeting a challenge.
So it's essential to understand the terms before signing on the dotted line.
Absolutely. And if your credit score has improved since you initially took out the loan, you might want to consider refinancing.
To potentially secure a lower interest rate.
Exactly.
All right, let's switch gears to something that might seem distant, but is crucial for a secure future retirement savings.
Yeah, retirement might feel ages away when you're in your 20s and 30s. But trust me, starting early is the single best thing you can do for your financial future.
Why is starting early so important?
It all comes down to compound interest. The earlier you start investing, the more time your money has to grow. It's like a snowball rolling downhill. It gets bigger and bigger over time.
So even small contributions now can make a significant difference later.
Absolutely. Let's say you invest $500 a month starting at 25. With an average annual return of 7%, you'd have over $1 million by 65.
Wow, that's a powerful incentive. Now, what if my employer offers a 401k plan?
Take full advantage of it, especially if they offer matching contributions.
Matching contributions meaning?
Your company matches a percentage of what you contribute. Essentially, it's free money boosting your savings.
That's incredible. Plus, I've heard there are tax advantages too.
You're right. Contributions to a traditional 401k are made pre-tax. So you reduce your current taxable income, leading to immediate tax savings.
So it's a win-win situation.
Exactly. You're saving for the future and saving on taxes today.
Now, what if my workplace doesn't offer a 401k? What are my alternatives?
IRAs, individual retirement accounts, they're a great option. There's the traditional IRA and the Roth IRA.
I've heard good things about the Roth IRA.
For good reason.
Uh,
With a Roth IRA, your contributions are made after taxes. But when you retire, you withdraw the money tax-free.
Interesting. So how do I choose between a 401k and a Roth IRA?
If your employer offers a 401k with matching contributions, always prioritize that. First, max out that match. It's free money. Then consider contributing to a Roth IRA.
Got it. So let's move beyond savings accounts. What other investment options are out there?
Well, there's the world of mutual funds.
What exactly are mutual funds?
They pool money from multiple investors to invest in a diversified portfolio of assets like stocks and bonds.
So it's like a team effort.
Exactly. Companies like Vanguard or T. Rowe Price offer a wide variety of mutual funds catering to different.
I've heard those mentioned a lot.
Index funds are a type of mutual fund. They passively track a specific market index like the S&P 500.
Meaning?
They mirror the performance of that index, providing broad diversification and typically with lower fees than actively managed funds.
And they historically performed quite well, right?
They have, which is why they're a popular choice for both new and seasoned investors.
Now let's talk about something many find confusing: credit scores.
Ah, yes, those mysterious numbers that seem to dictate our financial lives.
What are they really, and why are they so important?
Think of your credit score as a financial report card. It reflects your creditworthiness. Lenders, landlords, even some employers use it to gauge your financial responsibility.
So it's crucial to keep our credit scores in good shape.
Absolutely.
Yeah.
And the biggest factor impacting your score is your payment history. Pay your bills on time every time.
Okay, so timely payments are key. What else can we do to boost our credit scores?
Keep your credit utilization low. Don't max out those credit cards.
Credit utilization meaning?
The amount of credit you're using compared to your total available credit, aim to keep it below 30%, ideally lower.
So it's about using credit wisely, not necessarily avoiding it altogether.
Precisely. And make sure to check your credit reports regularly.
Where is this credit score information stored?
3 major credit reporting agencies, Equifax, TransUnion, and Experian. They each maintain a credit report on you.
Can we access these reports?
Absolutely. You're entitled to a free copy from each agency every year. You can get them through annualcreditreport.com.
Annualcreditreport.com.
Got it.
Checking our credit reports helps us catch any errors or inconsistencies, right?
Exactly. Early detection is key for maintaining good credit health.
This is all incredibly valuable information. Thank you so much for breaking it down for us.
My pleasure. It's all about empowering yourself to make smart financial decisions.
And it's clear that taking control of our finances, even with the ups and downs of the economy, is within our reach.
Absolutely. It all starts with understanding the basics, making informed choices, and building healthy financial habits.
Well said. We've covered a lot of ground today, from health insurance and debt management to retirement savings and investing. There's so much more to explore. So stay tuned as we continue our deep dive into Beth Kobliner's Get a Financial Life in our next episode. Okay, so we've tackled health insurance strategies for conquering debt, even dipped our toes into the world of retirement savings and investing. Phew. But how do we gauge our overall financial health? Is there a quick checkup we can do to assess where we stand?
There is. A good rule of thumb is the 30-10-20 rule.
30-10-20. I haven't heard of that.
It's a simple way to track your spending and savings. Aim to spend no more than 30% of your take-home pay on housing.
Okay, 30% for housing. What about the other two numbers?
Dedicate at least 10% to savings and strive to keep debt payments, excluding your mortgage, below 20% of your monthly income.
Those percentages provide a clear framework. What if my numbers are a bit off, though?
Well, life happens. Your financial situation is always evolving, but the key is awareness. If you're consistently exceeding those benchmarks, it's a sign you might need to make some adjustments.
Right, like reevaluating spending habits or finding ways to boost income. Got it. Let's circle back to debt repayment. We talked about tackling high-interest debt first, but are there other tactics for becoming debt-free faster?
Absolutely. Consider using savings to make a lump sum payment towards your highest interest debt.
That sounds counterintuitive. Wouldn't it be better to hold on to those savings?
It might seem that way, but remember, the goal is to eliminate that high interest burden as quickly as possible. You'll save a significant amount of money in the long run.
So short-term sacrifice for long-term gain.
Exactly. And don't underestimate the power of negotiation. Contact your lenders and explore options like loan modification or potentially securing a lower interest rate.
So being proactive and advocating for ourselves can make a difference.
It definitely can. Now let's shift gears to another essential aspect of personal finance: credit cards.
Ah, yes. Those ubiquitous pieces of plastic that can be both a blessing and a curse.
It all depends on how you use them. Choosing the right card depends on your spending habits and financial goals.
Okay, so how do we choose the right card? There are so many options.
If you tend to carry a balance, a card with a low APR, annual percentage rate, is crucial.
And if I pay my balance in full each month,
Focus on cards with no annual fee and a grace period.
what about those tempting teaser rates I see advertised?
Be cautious. Those teaser rates are often short-lived and can expire after a set period.
So always read the fine print.
Exactly. Balance transfers or new purchases might be subject to a different, usually higher interest rate once that introductory period ends.
Speaking of fine print, what about maintaining good credit health?
Ah, that's paramount. The most important thing you can do is make your credit card payments on time every single time.
I know it sounds basic, but even small slip-ups can have consequences, right?
They can Late fees and penalty APRs can damage your credit score, making it harder to get loans or even rent an apartment in the future.
So those seemingly small actions have a ripple effect.
Precisely. And while we're on the topic of cards, let's not forget about debit card safety.
Oh, right. Sometimes I overlook the potential risks associated with debit cards.
Unlike credit cards where you can dispute unauthorized charges, fraudulent debit card use can drain your checking account directly.
That's a scary thought. What steps can we take to protect ourselves?
Guard your PIN like it's a precious secret and scrutinize your bank statements regularly. Look for any suspicious transactions and report them immediately.
So vigilance is key. Got it. Now let's talk about our existing financial accounts. Are there opportunities to improve our situation by being more proactive with our bank or credit card companies?
Absolutely. Don't be afraid to advocate for yourself. Contact your financial institutions and inquire about better terms. Maybe you can negotiate a lower interest rate waive, an annual fee, or even secure a credit limit increase.
Never hurts to ask.
Exactly. The worst they can say is no. Now let's discuss those enticing reward programs that seem to be everywhere.
I'm always tempted by those. Are they truly worth it?
Reward cards can be beneficial if you pay your balances in full each month.
Okay, so responsible use is crucial. What if I tend to carry a balance, though?
The high APRs often negate any rewards you might earn. You're essentially paying more in interest than you're gaining in rewards.
So it's important to weigh the potential benefits against the potential costs.
Precisely. And keep in mind, those programs usually require high spending to reap significant rewards.
So it's not just about earning points, it's about spending responsibly, too. Speaking of responsible use, what about credit limits? What happens if we exceed our limit?
Maxing out your credit card sends a negative signal to lenders. It suggests potential financial strain and can hurt your credit score.
So it's not just about the immediate inconvenience.
Yeah.
It has long-term repercussions.
Exactly. It can even lead to higher interest rates on future loans. Now, let's circle back to student loans. We touched on them earlier, but are there specific strategies for managing federal loans effectively? Definitely. Contact your loan servicer and explore income-driven repayment plans.
Income-driven repayment plans meaning?
Your monthly payment is adjusted based on your income and family size. It can make those payments more manageable, especially if you're just starting out.
That sounds helpful. Any other options?
Extended repayment plans are another possibility. They stretch your payments over a longer period, lowering your monthly burden, but potentially increasing the total interest paid over the life of the loan.
Okay, so it's about finding the right balance based on our individual circumstances. Are there any tax advantages associated with student loan repayment?
There are. The interest you pay on your student loans is tax deductible. It can provide some relief when tax season rolls around.
That's good to know. Now, what about private student loans? They often have less favorable terms than federal loans.
If your credit score has improved significantly since taking out the private loan, you might consider refinancing or consolidating those loans.
To potentially secure a lower interest rate.
Exactly. It can save you money on interest payments and simplify your repayment process.
Okay, great advice.
Okay.
Now let's move on to another major purchase many of us face buying a car.
Yes, the car buying process.
Hmm.
It can be daunting, especially for first-time buyers.
Definitely. Any tips for navigating that process?
Research is your best friend. Investigate reliable car models, obtain vehicle history reports, and consider getting a pre-purchase inspection by a trusted mechanic.
So due diligence is crucial to avoid costly surprises down the road.
Precisely. And when it comes to financing, there's the age-old debate of leasing versus buying.
What factors should influence that decision?
Buying is generally the better option if it's financially feasible. You build equity in the vehicle and have the freedom to modify or sell it as you please.
And leasing.
Leasing can be attractive if you prefer driving newer cars more frequently, but remember, you're essentially renting the car for a set period.
So it's about weighing priorities and financial capabilities. What about alternative financing options beyond traditional auto loans?
You could explore home equity loans or lines of credit, HLOCs.
How do those work?
They allow you to tap into your home's equity to borrow money. But proceed with caution. Your home is used as collateral, so you risk losing your home if you default on the loan.
That's a serious risk, so HELOCs are not to be taken lightly.
Got it. Now let's talk about a sensitive topic, borrowing from family or friends.
It can be tricky, but if you must borrow from loved ones, treat it as a formal loan.
Meaning?
Put everything in writing, the interest rate repayment schedule, any other relevant details to prevent misunderstandings or conflicts in the future.
So clear communication and boundaries are key even with those closest to us.
Absolutely. Now remember, we discussed credit scores and their importance earlier. Don't forget to check your credit reports regularly.
Right. Annualcreditreport.com is the place to go for those free reports. What should we be looking for when reviewing those reports? Scrutinize every detail. Make sure all the accounts listed belong to you and that your payment history is accurately reflected.
So early detection of any errors or inconsistencies is crucial.
Exactly. Now let's touch on a topic many avoid: bankruptcy.
It's definitely not a pleasant subject. But when does it become a viable option?
Bankruptcy should be considered a last resort when you're overwhelmed with debt and unable to meet your financial obligations.
So it's not a decision to be taken lightly.
Not at all. It's a legal process that can provide relief from debt, but it comes with long-term consequences for your credit score and financial future.
So explore all other avenues before considering bankruptcy.
Precisely. Seek professional advice and weigh the pros and cons carefully. Now let's shift our focus to choosing the right bank.
That can feel overwhelming. There are so many options.
Look for institutions that offer FDIC insurance, which protects your deposits up to a certain limit.
FDIC insurance is a must. What other factors should we consider?
ATM fees online and mobile banking capabilities, the quality of customer service, those are all important considerations.
Okay, so it's about finding a bank that aligns with our needs and preferences. What about overdraft protection?
While it can prevent bounce checks, be mindful of the fees associated with overdraft protection.
So it's not always the best solution.
Linking your checking account to your savings account is often a more cost-effective way to avoid those pesky overdraft fees.
Interesting. Can building a good relationship with my bank actually benefit me?
Absolutely. Cultivate a rapport with your bank manager. They might be more inclined to waive fees, offer personalized advice, or provide assistance if you encounter financial challenges.
So it's about more than just transactions. It's about building a connection.
Exactly. Now let's dive deeper into the exciting world of investing.
Yes. More investing insights, please.
Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes like stocks, bonds, and real estate.
Ah, diversification. The golden rule of investing. What about those money market funds I've heard about?
They're a good option for short-term savings or emergency funds. They invest in low-risk, short-term debt securities, offering stability and liquidity.
So not necessarily for growth, but for preserving capital.
Precisely. Now, remember that fundamental principle we talked about earlier, the relationship between risk and return.
Oh, right. The higher the potential return, the higher the risk.
Exactly. It's a balancing act. You need to find the right level of risk based on your time horizon, financial goals, and risk tolerance.
So don't shy away from risk entirely.
Not necessarily. Taking calculated risks can be crucial to outpace inflation and reach your financial goals.
It's about finding that sweet spot between caution and opportunity. Got it. Now let's break down those stock funds. We touched on them briefly, but I'm eager to learn more.
Stock funds pool money from multiple investors to buy a diversified basket of stocks, offering the potential for growth, but also carrying the inherent risk of market fluctuations.
Okay, so potential rewards come with potential risks. What about understanding the stock market itself?
The stock market is where publicly traded companies issue and sell shares of their stock. Stock indexes like the S&P 500 track the performance of a group of representative stocks, giving us a snapshot of the overall market.
And bond funds. How do they differ from stock funds?
Bond funds invest in bonds, which are debt securities issued by governments or corporations. They typically offer lower returns than stocks, but with less risk.
So bonds are generally considered a more conservative investment option.
They are. Now, have you ever heard of deflation?
I've heard the term, but I'm not sure I fully understand it.
Deflation is a sustained decrease in the general price level of goods and services.
Hmm.
It can negatively impact economic growth and investment returns.
So it's essentially the opposite of inflation.
Precisely.
Hmm.
Now, when it comes to investing, managing those pesky fees is crucial. What are the typical fees associated with mutual funds that we should be aware of? Watch out for expense ratios, loads, and 12b-1 fees.
Can you break those down for us?
Expense ratios cover the fund's operating costs. Loads are essentially sales charges, and 12b-1 fees cover marketing and distribution expenses.
Okay, so those fees can eat into our returns.
They can. Choose funds with lower expense ratios whenever possible.
So where's the best place to purchase mutual funds, minimizing those costs?
Consider buying directly from low-cost companies like Vanguard or Fidelity. They offer a diverse selection of funds with low expense ratios.
So cutting out the middleman can save us money.
It definitely can. Now, let's talk about something that's gaining popularity: socially responsible investing.
Oh yes, aligning our investments with our values. I'm curious to learn more.
It's about considering environmental, social, and governance factors when making investment decisions. You're supporting companies that align with your ethical considerations.
So it's not just about financial returns, it's about making a positive impact.
Exactly. Now remember those retirement accounts we discussed. They're designed for long-term savings, but are there any situations where accessing those funds early is permitted? While early withdrawals generally incur penalties, there are exceptions. Hardship withdrawals or using funds for qualified educational expenses are potential scenarios where early access may be allowed without penalty.
Okay, so there are some exceptions to the rule. What about inflation? We talked about it briefly earlier, but can you remind us how it affects our long-term savings goals?
Inflation erodes the purchasing power of money over time. That's why investing is so crucial. It helps your money grow at a rate that outpaces inflation.
Right, so our savings don't lose value over time. What about those tax-advantaged accounts? We know they're beneficial for retirement savings, but can you elaborate on how they work?
Accounts like IRAs and 401k offer tax advantages that can significantly boost your savings. Contributions to traditional IRAs and 401ks are often tax-deductible, reducing your current tax liability.
So we're saving for retirement and saving on taxes in the present.
Precisely. And when it comes to employer-sponsored retirement plans, you'll often encounter the term vesting.
What exactly does vesting mean?
Vesting refers to the ownership you gradually acquire over employer contributions made to your retirement account.
So it's not immediate ownership.
Typically, there's a vesting schedule. You need to work for the company for a certain number of years to be fully entitled to those contributions.
Okay, so it's important to understand the vesting schedule of your specific plan. What about choosing investments for an IRA? Any recommendations?
Low-cost index funds like the Vanguard S&P 500 Index Fund or the Vanguard Total Stock Market Index Fund are popular choices for IRAs.
They offer broad diversification and have a history of solid performance.
Exactly. Now, what about those who are self-employed? What retirement planning options are available to them? They have access to retirement plans like simple IRAs, SEP IRAs, and KEO plans. These plans offer tax advantages and allow self-employed individuals to contribute a significant portion of their income towards retirement savings.
So there are tailored options for those who work for themselves. Retirement planning can feel overwhelming. Are there any resources or tax breaks available to simplify the process?
Absolutely. The Savers Credit is a valuable tax break for individuals with modest incomes. It provides a tax credit for contributions made to retirement accounts like IRAs and 401ks.
That's good to know, so don't hesitate to explore all available resources. Now let's talk about the housing market. It can be quite unpredictable.
It certainly can. Affordability and long-term goals should guide your decision of whether to buy or rent.
Okay, so how do we determine what's right for us?
Consider your financial situation, your lifestyle needs, and how long you plan to stay in the area.
So buying might be a wise investment if we're financially prepared, but renting offers flexibility.
Exactly. For those leaning towards renting, any tips for navigating that process? Do your homework, research potential rental properties thoroughly, consider location, amenities, safety, and don't be afraid to negotiate rent and lease terms.
So being proactive and informed can make a difference.
Absolutely. And for those considering homeownership, what factors should they weigh before taking the plunge? Your credit history, down payment capabilities, income verification, and mortgage terms are all crucial aspects to consider.
What about getting pre-approved for a mortgage?
It's a smart move. It strengthens your negotiating position and streamlines the buying process.
Got it. Now let's talk about the different types of mortgages. Fixed rate and adjustable rate mortgages. What are the key differences and potential risks?
Fixed-rate mortgages offer predictability. Your monthly payments remain the same throughout the life of the loan. Adjustable-rate mortgages, or ARMs, have interest rates that can fluctuate.
So ARMs carry more risk.
They do. Your monthly payments could increase if interest rates rise.
Foreclosure is a scary thought for any homeowner. What resources or options are available for those struggling to keep up with their mortgage payments?
Don't delay seeking help. Explore refinancing programs through government agencies like the FHA or Fannie Mae. Consider loan modification possibilities where you negotiate new terms with your lender.
So there are avenues for assistance.
There are organizations like the Homeownership Preservation Foundation can provide guidance and support to homeowners facing foreclosure.
It's reassuring to know there are resources available.
Now let's talk about insurance, a crucial aspect of managing financial risks.
Insurance protects you financially against unexpected events like accidents, illnesses, or property damage.
Right, it's about transferring risk.
Exactly. By paying a premium, you're shifting the financial burden of potential losses to the insurance company. Okay, so what are the different types of insurance we should be aware of?
Let's start with health insurance. It's essential for everyone. There are various types of plans: HMOs, PPOs, POS plans, and indemnity plans, each with its own network of providers, coverage options, and out-of-pocket costs.
So choosing the right plan depends on individual needs and preferences.
Exactly. Now let's not forget about auto insurance.
Another necessity. What are the essential types of coverage, and are there ways to reduce those costs?
Liability coverage is mandatory in most states. It protects you financially if you're at fault in an accident. Collision coverage and comprehensive coverage protect your vehicle from damage.
Okay, and how do we save on those premiums?
Maintaining a safe driving record, shopping around for the best rates, and choosing cars with good safety ratings can all help lower your insurance costs.
So being a responsible driver pays off literally. Now, what about disability insurance?
It provides income replacement if you're unable to work due to illness or injury.
I haven't given that much thought.
It's often overlooked, but incredibly important, especially for younger individuals.
Okay, I'll add that to my list of research. Now on to home insurance.
It typically covers the structure of your home, your personal belongings and liability if someone is injured on your property.
Are there any additional coverage options we should be aware of?
You might consider additional coverage for specific risks like floods, earthquakes, or valuable items like jewelry or art.
So tailor your coverage to your specific needs.
Exactly. Now, have you ever heard of umbrella liability policies?
I have, but I'm not entirely sure what they are.
They provide an extra layer of liability coverage beyond your homeowners and auto insurance limits.
So it's like an extra safety net.
Precisely. It protects you if you're sued for an amount exceeding your primary insurance coverage.
Who should consider umbrella policies?
Individuals with significant assets should strongly consider them. Now let's talk about life insurance, a topic many find uncomfortable.
Yes, it's not the most cheerful subject, but it's important.
There are two main types: term life insurance and cash value life insurance. Term life insurance provides coverage for a specific period, while cash value life insurance combines a death benefit with a savings component.
Okay, so which type is best?
Term life insurance is generally more affordable and suitable for younger individuals who need temporary coverage.
Got it. Are there any types of insurance that we should avoid?
Be wary of add-on insurance products like rental car collision protection or flight accident insurance.
Why those in particular?
They often duplicate coverage you already have through your existing auto or travel insurance policies.
So it's about being a savvy consumer. Now let's switch gears to wills and estate planning.
It might seem like a distant concern, but it's crucial to have a will even for younger adults.
Why is that?
A will ensures your assets are distributed according to your wishes and that guardians are appointed for your children in case of your passing.
So it provides peace of mind and avoids potential complications for our loved ones.
Exactly. Now let's demystify the often dreaded tax system.
Yes, please. Taxes can feel like a labyrinth.
The U.S. tax system operates on a pay-as-you-go basis where taxes are withheld from your income throughout the year. Understanding tax brackets, taxable income, and the various deductions and credits available can help you minimize your tax liability.
So it's about being informed and proactive.
Precisely.
That.
Now let's talk about tax forms.
Just the mention of tax forms makes me anxious.
Don't worry, they're not as scary as they seem. Familiarize yourself with the key forms. W-2 forms report your wages and taxes withheld by your employer. 1099 forms report income from sources other than employment.
Okay, so keeping track of those forms is essential.
Absolutely. And what about those deductions and credits that everyone talks about?
Can you break down the difference between them and how we can utilize them to our advantage?
Deductions reduce your taxable income, while credits directly offset your tax liability.
Okay, so both can save us money come tax season.
Exactly. Common deductions include mortgage interest, state and local taxes, charitable contributions.
Yeah.
Tax credits like the child tax credit or the earned income tax credit can provide significant savings.
So it's worth exploring all available deductions and credits.
Absolutely. Now, what about choosing a tax preparer?
It can feel overwhelming finding someone trustworthy.
Look for qualified professionals like certified public accountants, CPAs, or enrolled agents. Consider their experience, reputation fees, and whether they specialize in your particular tax situation.
So do your research and choose wisely.
Precisely. And always review their completed work before filing your tax return.
Excellent advice. Now we've covered a vast amount of information today. It's a lot to process.
It is. But remember, personal finance is a journey, not a destination.
All right, we've covered so much ground in this deep dive, from health insurance and managing debt to the intricacies of retirement planning and investing. It's a lot to absorb.
It is, but let's distill it into 10 key takeaways. A roadmap for achieving financial well-being.
Love it. 10 actionable steps we can start implementing today. What's number one on our list?
Prioritize those high-interest debts, especially credit cards. Tackle them head-on and free up cash flow for other financial goals.
Okay, high-interest debt is public enemy number one. What's next?
Automate your savings. Set up automatic transfers to your savings or investment accounts. Make it effortless and watch your money grow.
Automation, the key to consistency. What's our third financial imperative?
Start saving for retirement early. Harness the power of compound interest. The sooner you begin, the better.
Retirement savings, the gift that keeps on giving. What's next on our financial to-do list?
Understand and monitor your credit score. It's a powerful number that impacts various aspects of your financial life.
Credit score, a 3-digit number with a big influence.
Got it.
What's our fifth key takeaway?
Don't be afraid to negotiate with lenders. Whether it's for a lower interest rate or a loan modification, advocating for yourself can save you money.
Negotiation, the valuable skill in personal finance. What about insurance?
Shop around for the best insurance coverage. Compare quotes from multiple companies. Don't settle for the first option you find.
Smart shopping applies to insurance too. What's next on our list of financial wisdom?
If you need life insurance, opt for affordable term life insurance. It provides essential coverage without breaking the bank.
Term life insurance, simple and affordable. Got it.
Yeah.
What else should we keep in mind?
Track your spending. Create a budget. Gain awareness of your financial habits. It's the foundation for making informed decisions.
Budgeting, the cornerstone of financial well-being. What's our final pearl of wisdom?
Don't hesitate to seek professional advice when needed. Financial advisors, tax preparers, or credit counselors can provide personalized guidance.
Expert advice is invaluable. So there we have it, 10 key takeaways to empower us on our journey towards financial well-being. Any final thoughts for our listeners as they embark on this path?
Remember, even small, consistent actions can lead to significant results over time. Start implementing these principles today and watch your financial future flourish.
Thank you so much for joining us on this deep dive into personal finance. We hope you feel equipped and inspired to take control of your money and build a brighter future. Until next time, happy saving, investing, and planning.